Welcome to the weekly update. This is actually take two. I got about halfway through the video and I lost my internet connection, and so I'm having to start over with this, where I'll go over the action in the market for the week of April 29th through May 3rd, and then we'll see how things look for the week of May 6th through the 10th. We saw an up week. We're seeing a lot of improvement across the daily charts. We haven't quite turned positive yet. We're in the process of potentially turning positive. We're camped out not only with the S&P, but with a number of different indexes right at the 50-day simple moving average. So we want to keep an eye on that. This is kind of the line in the sand for some folks in the intermediate term to define whether we're positive or negative. Well, we're right at that point right now. Before I get started, please know that I do a video every day. Some of you may find those useful. I know they're longer. I try to cover as much as I can in as quick of time as possible. There's a lot of information that we have to go through each day to kind of get a really good handle on what's going on in the markets. But please feel free to check those out if you have the time to watch them. Also, I have a number of videos. It's in a playlist on the YouTube channel where you can just go through them 1, 2, 3, 4, 5. And it's about the program that I'm hoping to launch in June. And I'm in the process of recording the courses that go with that program. There's a PDF with every video that I post, whether it's on YouTube or Rumble. Some folks find that helpful. I also have now incorporated a what to watch video. That's where it's the last video that I do of the week over the weekend. And it's what I'm really honing in on. And it changes every week. And I try to keep it a little bit shorter, but there's been so many different things going on lately that it's actually developed into a little bit longer video. I do also update pivot points on the YouTube community tab. I can't do this on Rumble. There's a daily chart where I update it each day with the new candle for that day. And then every day there's intraday pivot points that can be very useful that only last for that particular day. I do have a private Facebook group, but it's not really all that active. I'm probably going to change that into something else as I get the program going. I'll be going through the results of the latest poll, and I'll be posting a new poll for the upcoming week. Also, they must have started doing their webinars again. I've been getting hit with a lot of comments on Rumble about how these experts with video production can take my channel from a loser channel and make it a winner channel. Well, for me, it's about quality, not quantity. And I'm just fine with the way things are going. I also post on Rumble as well as YouTube. If you can't find me on one platform, you may want to switch over and try to find it on the other platform if you think that a new video should be there. And here's the link. It's also in the description below the video. Let's go back and talk about what happened. For the week, we were up 1.26% on above average volume. We are seeing that pick up, and that's just showing there's more participation. We're still positive. We're positive in the long term on the daily charts. We're negative and possibly switching back over to positive on the daily charts as well in the short and intermediate term, where we're still looking okay here with the weekly charts, but there's some areas of concern that we'll go through. And the last couple of weeks have really been about inflation and interest rates, where the market had been anticipating these rate cuts. Now that seems to be shelved for right now, and they were starting to worry about rate hikes. Well, when the employment situation report came out on Friday, that was weaker than expected, and that's why we saw a really solid up day. So it wasn't too strong to suggest that we're inflationary, and it wasn't too weak to show that we're falling off a cliff. So they're kind of calling it the Goldilocks employment situation report. But we just want to keep an eye on those things, as well as the geopolitical things that are happening. And if in the US, it's mainly about the protests, which really, they don't have much of an impact. Now, if you're from the Seattle area like I am, everything's all about a zebra that they may be calling DB Cooper because they can't seem to find it. I don't know if any of you are aware of that, but there's all these interesting pictures going around of this zebra in different places in the Seattle area. That's really kind of clever. We are dealing with earnings season, and we still have a ways to go with that. But most S&P 500 companies have now reported, and the Fed doesn't meet this week. They met last week, but they may be giving some speeches that we kind of want to tune into. Condition of our trend, we are weakening. The ADX is still below the moving average. It's still a positive trend. The green line's on top, but the green line's coming down too. So this also suggests it's a positive weakening trend. Just some bullet points for the week. It was a very choppy session because we had a lot of earnings reports, there were economic reports, but ultimately by the time we finished, we were up on the week. And the Russell 2000, now this is a little bit different than how I calculate this. They may choose a different day to start from. Now they're showing that small caps based on the Russell 2000 are up 1.7% since last Friday, and they're also positive now on the year. I still have them being negative going back to January 2nd. Maybe they start December 31st. Mega caps had another good week. Earnings kind of helped a lot of those companies, such as Apple and Amazon. They had positive earnings reports. And then looking forward, the market seemed to like what they had to say. There are concerns about sticky inflation. The Fed's trying to get back down to 2%, and it's getting a little stubborn, and they call that sticky inflation. It's actually starting to turn back up a little bit, and that's causing some concerns. So we don't really know about this whole timeline with any kind of rate cuts. The market is also kind of keeping in the back of its mind that the Fed may have to come in and actually raise rates. And then Fed Chair Powell did calm some nerves on Wednesday during his press conference, where he said that it's unlikely that the next policy rate move will be a hike. Now, that could always change, but that's just how things look right now. And the market liked that. But we did a whole round trip ticket on Wednesday. I'll show you that in the chart. And the Fed did meet this past week, and they decided to leave the Fed funds rate unchanged. And that was as expected. Now we're starting to look further down the line at future Fed meetings. And then on Friday, we did get the employment situation report where it was weak enough to kind of curtail for right now any concerns about a rate hike, but it was strong enough to show that the economy is still hanging in there for right now. Interest rates were down from where we were a week ago. Last Friday with the 10-year, we were at 4.67%. This Friday, we closed at 4.5%. And I usually don't talk about this, but the 2-year note, which is 2-year versus 10-year, it got up to 5% a week ago, and it declined down to 4.81%. Still inverted, still higher than the 10-year, but down from the levels where it had been. Oil did fall back down below 80. It closed at $78.05 a barrel. And both the S&P 500 and the NASDAQ were right at those 50-day simple moving averages. And those are pretty critical. And we're seeing it across not just the S&P and NASDAQ. There's some other indexes where we're seeing that right now. And that's the dividing line between positive and negative. So we want to really keep an eye on that. So for the week, the Dow was up 1.1%, the NASDAQ up 1.4%, the S&P was up 0.5%, and the small caps, according to the Russell 2000, were up 1.7%. And then I've been showing this chart for about a year now. It's not so much, this light blue line is what we're following. It's not so much the decline, because even when we were declining, we did see blips up, and maybe that's what we're going through right now. It's keeping in the back of our mind what happened after that. This is massive inflation. This is stagflation, where we have ultra high inflation with little to no economic growth going on during that time. That was a very difficult time in the mid to late 70s before it finally got back under control in the 80s. We just want to be aware of that. Not predicting that. We don't know if that's actually going to happen, but it has happened before. And this climate from 1975 into 76 was looking more positive. That was our bicentennial year. But then it started to look pretty bad after that. And things can always change. Then according to RenMac, when we're above the 4.02% with the 10-year yield, that's when it starts biting into corporate profits. We're at 4.5% currently. Here are the poll results. And here's the first one where it says the S&P is slightly above its 100-period simple and exponential moving averages. A week ago, do you feel that this level will hold, that we're going to continue down to the 200-day moving average, or that we'll break the 100 but not get down to the 200-period moving average? 30% thought that we would hold, and that's what ended up happening, where 40% thought we would break it but not go down to the 200-day. 30% thought that we were going to go all the way to the 200-day moving average. So the first answer was what actually happened. Interest rates in the dollar continue to climb. They were actually down this past week. Do you feel that this will continue? 100% thought yes. It turned out to be no. Then do you feel that geopolitical events in the Middle East will impact stocks this week? And that really didn't have much of an impact right now. And those that said no were 63%. And that's really the right answer there. Stocks, again, a week ago had another rough week. Do you feel that this decline will continue or there will be a bounce? 45% thought that we would keep declining, where 27% thought that we would bounce. Also, 27% thought we would end up flat. We ended up having a bounce. So that ended up being how things played out. Here's some blog charts to show you, and I've been showing this for a long time now. We don't really know where we're at right now. We were kind of leaning towards this slow cycle, but now that the rate cuts may be coming off the table, we don't know if we're going to be in that slow cycle. We're not necessarily in a fast cycle unless something catastrophic happens. So we're kind of in limbo as far as this chart is concerned right now. We are looking okay, going out with earnings, looking into the future. That's still going up. And then looking at this, when you compare, we started in October of 2022 with this bull market. Didn't feel like it at the time. It's just kind of developed into one. And right now it's 18.7 months old. Well, the average is 57.6 months. So that's why they say that it's not all that old yet. And you can see the corresponding returns during those bull markets. So if we are to continue with this bull market, we still have a ways to go according to the average time. Then looking at this, the top 10 weight of the S&P 500, yeah, I don't know, why don't they do the Magnificent Seven? There was another one that we looked at last week where they talk about the Magnificent Seven, but then they only show the top 5. So, but this just shows how much these stocks really have an impact on the price of the S&P 500. And then here we're seeing a lot of outflows in crypto right now. A lot of money's coming out, but right before I started recording, I checked it, and we're back up into the 60s over the weekend with Bitcoin anyway. And then this is the chart that we usually get after the employment situation report, or if we look at this red line, that's all employees, including temporary help services. When this starts to decline, that often drops below this flat red line, and then we go into a recession after that. Well, we dropped below the red line, but we've not gone into a recession, at least as of yet. The hope is that maybe we'll start to go back up without going into a recession. Now, this red line could turn and go back down, but it has not done that yet. Then looking at the underlying inflation, that's the dark blue line here, where it's starting to turn back up, where the Fed wants to get down to this 2% level. And then the leading indicator, what they do is they take the new orders and inventories and then shift it forward 3 months. That's the light blue line where it's starting to come down. Is that going to be reflected in the ISM itself, which is the dark blue line? Are we going to see more weakness there? 50 is the line in the sand. When we're above 50, that shows expansion in the economy. When we're below 50, that means a contraction in the economy. Then FactSet just had one post here, just an update. As of Friday, 80% of S&P 500 companies have reported. 77% are above their estimates, which you can look at the 5 and 10-year average. When you take it together, we're 7.5% above the estimates as of right now. Looking at the intraday chart, Monday was kind of a flat day. There really wasn't much going on that day. It was waiting things out to happen later in the week. We did see a down day on Tuesday with a lot of selling going right into the close. And then we were pretty quiet on Wednesday. And then this is when Jerome Powell started to speak, and we just did a whole round trip. It's like to the moon and back. We just finished about where we started. Then on Thursday, we saw a little bit of strength later in the day. We were able to break above this intraday resistance and then get all the way up. And then we closed a little bit off the high, but this is more uniform with an improvement. And then on Friday, most of the gains were seen in the gap open, and we were just able to hold on to those going into the close. This is the indexes for the week, and it's only the 5 trading days here where all of the indexes were up, but the NYSE was down slightly for the 5 trading days. Going back to the beginning of the year, this is where I have a little bit different figure, where I still have small caps negative with all the other indexes positive. Looking at our sectors, since we had an up week, utilities saw a nice little bounce. They were up the strongest, followed by real estate, which has also been getting hammered lately. The tech sector, which has been doing well, and we're seeing some improvement with discretionary for right now. The financial sector was down a little bit, but it's still hanging in there and looking okay. Where energy had been stronger, now it's starting to pull back, and that sector was down on the week. Then I sort this according to the Scooter score. The closer it is to 100, the better looking that sector. We don't have anything in the 90s right now, but we have industrials, communication, and utilities are in the 80s. And then at the bottom, we have real estate still looking the weakest. Here's our relative rotation graph. Here's the plus plus area, the top right part. Now this goes back a year. So we have energy, which is still holding up quite well over the last year. And then we have materials looking better, and then industrials, and then the financials. These are all green. We're seeing communication pulling back a little bit. Tech has been pulling back, but then the weaker areas have been real estate and discretionary, which has been a disappointment. A lot of that has to do with Tesla. And then healthcare has also been, and that tends to be more of a defensive area. Then going back and looking into major market indexes, we still have the mid caps holding up the best over the last year. And we found some support off the mid caps. We found a pivot point on a daily chart that the market was able to bounce up off of that. That closely corresponded to the 100-day moving average on the S&P, where we still have the S&P and S&P 100 pulling back a little bit over the last year, but still looking okay. The NASDAQ 100 also showing a little bit of weakness, where the small caps and transports, they've been weak, and then the Dow Jones Composites also been weak. And it's not that the Dow's showing a lot of weakness, it's that the transports and the utilities have been showing a lot of weakness. And then utilities are showing some improvement over the last year, when we benchmark this to the Wilshire 5000. So for the week, the sectors that were up were utilities, communication, tech, real estate was up just a little bit, and healthcare, where all of the other sectors ended up being down. Going back to the beginning of the year, communication, energy, and industrials are up. All of the other sectors are down year to date. Looking at sentiment, this is kind of funky. They were getting some strange numbers here. We'll go over and look at the chart where we were coming down. We tend to ride this when it's not extreme, so we were turning more negative. Then we were starting to bounce up, then we fell back. Now it looks like we're starting to improve again. The active asset managers are still right around the neutral area, not leaning necessarily one way or the other. Here's another look at that same chart coming in at 61.97. The VIX did decline with the line chart as well as the bar chart as we had an up week. And the Ulcer Index, it's still underneath its moving average. We've been seeing a decline on the daily chart. It's actually dropping below the moving average where it had been above. And the Ridex Bear Bull ratio, these poor folks. This is Thursday's close. Okay, we had the monster update, not monster, but really good update on Friday. Most of these folks are in the bearish funds. So my goodness, they're kind of doing exactly the wrong things at the wrong time. We're neutral with investors' intelligence with the latest reading, and we're turning back a little more positive with the American Association of Individual Investors, where they had gone slightly negative. We're still looking okay here when we compare cash to the tech sector. When this black line continues to go down, that means the tech sector is outperforming cash. Here's the latest readings from GDP Now, where they have us up just a little bit under 4%. When you look at the forecast, we're just under 3% and at about 1.5% to the downside. And here's the bar chart, columns you could look at here, where we're really focusing on the first quarter, but now we're starting to project out into the second quarter. And then the spread between risky and not as risky bonds, it's still continuing to go down. If it was going up, that would cause concern. We're still below the black line with the Chicago Financial Conditions Index, and we're coming up, but we're still below the red line with the real-time SOM recession rule recession indicator. You think they come up with these little short names, but no. And we also had an update of the smooth U.S. recession probabilities. We're above the black line, but still below the red line. And we came down just a little bit with the latest reading of the Brave Butters leading Kelly. Got to include Kelly in the leading index. Inflation actually ticking down just a little bit over the last couple of days. And then the Fed right now, so the May meeting is finished. Now we're focusing on the June meeting. And right now, as of Friday, there's a 91.6% chance that they're going to leave rates unchanged. And you can see how that's changed. Where a month ago, not many people thought that. Now that's kind of the going thing, where a lot were thinking we were going to get a 25 basis point cut. Now, not as many people are thinking that. Some were even thinking about a 50 basis point cut a month ago, not even registering now. Then we look out at the July 31st meeting, a little more of a split here. 62.7% chance that rates will stay the same, 37.3% that they're going to cut them 25 basis points. This has also shown a big change where most people were thinking, nah, rates aren't going to be where they are now. They're going to cut them to either 25 basis points or 50 basis points, where now this is becoming more of the prevalent viewpoint as far as probabilities based on this chart. We are still declining here with the Fed balance sheet, and on a year-over-year basis, we're actually going back up just a little bit here, even though we're showing a minus up here on top. Can't figure these Fed charts out sometimes. Looking at our advanced decline line, we are above the moving averages based on price and volume and showing some improvement there. We're improving too on the daily charts as well. This is more positive that I'm seeing on the daily charts, where the new highs are really holding up better than any kind of an expansion and new lows. And on the daily charts, we're looking more positive. Also, we're going up with the 4-week and the 10-week moving average on this chart. We're positive with the advanced decline ratio. We're above 0. And the accumulation distribution on the daily chart, we're right on the moving average, where we continue to be more positive here on the weekly chart. Here's our trend where we are coming down below the moving average. That suggests a weakening trend. The green line's on top, so it's positive, but the green line is also declining. So that confirms this weakening trend that we're seeing right now. The Erin indicator is positive. We're above the midpoint. We have the green line on top, that's buyers, and it's coming down, but we're also seeing a decrease in sellers. So this, when you compare the two, it continues to be positive. The mass index is actually generating something on the daily chart, but we're not seeing anything here on the weekly chart. Looking at the daily chart, we're right at the 50-day moving average. Yeah, that's a pretty good line in the sand for the market right now. And when you look at the Keller market model, we've switched back to positive in every time frame across all the different indexes. We're still negative with the Keller market model with bonds based on price. We're negative in the short term with commodities, and now the dollar's been under some weakness. It was in the 106 area, now it's dropping into the high 104s. No changes here on the decision point scorecard. We're negative in the short term, positive in the intermediate term, and mixed in the long term. We're still above the trend line with this long-term trend channel going back to 2009. And we got a little bit above this with the weekly chart of the pivot points here. We closed above that 5110, 5111 level. We closed at 5127. So we were able to recapture that on a Friday. So this is a weekly bar now that is showing some improvement here. When we look at the trend, we're going back up, but the red line is still going up. So the 50-week simple moving average continues to be positive. With our crossover moving averages, we're coming right back up to this 13-week moving average. We need to see it break above that. Longer term, we're still positive. And this is an improvement too. The McClellan oscillator is above 0 and actually advancing. So that's turning more positive. We're trying to turn back up with the summation index based on price, but we haven't quite done that yet. But we're still above 0. We're showing an improvement with volume, but we're still below 0 there. So still some mixed pictures in that chart. We came down with the Swenlin trading oscillator based on price and volume, but we're still above 0. And we're above 50 and going up with the bullish percent index. So that is showing some improvement there. And we're showing some improvement, but still negative with the PMO. The PMO is now crossing below the moving average on the weekly chart. We're below based on price, below based on volume, even though we did tick up a bit here. We're seeing the PMOs rising. That's showing some improvement. The buy signals are improving, but we're still pretty much flat to slightly declining with the PMOs above 0. We're above the midpoint with the percent B indicator, and we look for this when it closes above or below the upper or lower Bollinger Band. We're about in the middle now, so we're not getting a reading there. So the slope oscillator is going down. The TSI, these are our shorter term oscillators. We're seeing the MACD, the PMO, and the PPO. They're turning negative. Our longer term oscillators are starting to cross over negative, the TRIX and the KST. The Chaikin money flow is continuing to decline, but it's still above 0. Chaikin oscillator turned back up and is above 0. That's positive. The force index switched back over to positive on the daily chart. We're also positive on the weekly chart here. We're above 50 and trying to go back up with the money flow index. And with the up week, even though it wasn't up as much as the previous week, We're still positive, and we're still staying above this red line here with the 50-week rate of change. The RSI is continuing to go up and is above 50, so that's showing some improvement. We're still negative here with the special K weekly chart, where we continue to be positive with the daily chart. And after being extreme negative with the Stoic RSI, we're now no longer extreme and starting to bounce up out of that. The Williams percent R is above 50 now and showing some improvement. The ultimate oscillator is above 50 and going up. So you can see how some of our oscillators are continuing to show some improvement here. The vortex continues to decline with the green line, and the red line still coming up, but we're still positive there. The Copic curve is negative on the weekly chart, where we've switched over to positive on the daily chart. And we're coming right back up to this 10-week moving average, which is providing overhead resistance right now. We want to be able to get above that for things to turn more positive. We're still pretty choppy right now with our long-term equity put call ratio, but we're continuing to decline here, which is longer-term positive. We're still going up with the VIX to 3-month average of the VIX. That's more negative. And then our different charts, we're showing kind of a doji candle right here for the Heiken Ashi, which is more indecisiveness right now, where we're still looking positive with the Kegi chart, we're positive with the Renko chart, but we're looking more negative with the 3-line break. So again, some mixed signals here. We're still above zero, but declining with the ease of movement going back 14 weeks. And no new X's or O's were drawn on the point and figure chart, so nothing has changed there. With the momentum, we're still declining in the long term and intermediate term, where we're switching back to positive in the short term with the PPO study. And we're kind of in the middle of the 50-day cycle now. I don't base things around this, any decisions, but this is kind of interesting to watch. We are continuing to be neutral with the Elder's Impulse system for the S&P, where we're looking a little more positive on the daily chart. We're still negative here with the parabolic SAR weekly chart. The dots are on top, where we're positive on the daily chart. Broad market, we're now in the month of May, which over the last 4 years has been positive. So it has 100% rate of success with about 1.4% average return for the month. Looking at the S&P, the mid caps, they're holding up a bit better now, with the small caps still lagging behind. They're stuck in a range right now. And until they can really break out of that range, it's going to be hard to really favor that area of the market. Looking at the Dow, we're coming up to the moving average, but still in an uptrend. The NASDAQ, just a little bit above the moving average, but in an uptrend. The NASDAQ 100 right at the moving average, but in an uptrend. And here's another weekly chart of the QQQs, where we were up on the week. We've seen 2 back-to-back up weeks now. The mid caps are a little bit above the 50-week, or I should say the 50. Okay, let me back up. This is the 13-week moving average, which I kind of equated to a 50-day moving average. Price is actually above this a little bit, where we're right on the 50-day moving average on the daily charts. The small caps are still in an uptrend, but continue to be more or less range bound. The NYSE right at its moving average. The Wilshire right at its moving average. All stocks just a little bit above its moving average. Software companies still dealing with this longer term moving average, not seeing an awful lot of strength there. The FANG index is a little bit above its moving average, and ARK, just kind of wherever ARK is these days, floating around somewhere. Then the bank index that we follow, we're still above 50 and going up with this ETF that we follow. And price is looking a little more healthy, and we're kind of mixed right now with momentum. It doesn't know if it wants to be positive or negative. And then the deposits are still going into commercial banks, so that's showing a little more confidence. And then we just look at a chart of Dow theory with no studies on them. With the Dow, the transports are just not helping things out. The utilities have been really under pressure, but lately have been coming back. The broad market, the CRB index, has been in an uptrend, but saw a real decline. It was down almost 3.5% on the week. Oil is now dropping below 80. And as things seem to be a little more okay in the Middle East currently, copper is still looking pretty good and is in an uptrend. That suggests economically going forward, things are positive, even though we were down on the week. And here's the dollar, where we got up into the 106 range. Now we're in the high 104s. Gold still continues to pull back, but it's still in an uptrend. Silver is also pulling back, but in an uptrend. And we look at total bonds, where we've been just really struggling here. We're still in an uptrend, and we've been just kind of bouncing around with prices lately. We're still showing that stocks are outperforming bonds on the monthly chart, and we're still negative here with the 1 month subtracting the 3-month yield. And you can see where interest rates were going up, but then they really dropped off later in the week, and that was giving support to stocks. Looking at a weekly chart, we were down with US, UK, and German rates. Japanese rates were down just a little bit on the week. And then I've been showing this, because if we finally get up to that 5% level, spike and then come down, sometimes when we've seen a real spike like this, that usually means something bad is happening. Well, we don't know. This is from last October, and we're still waiting to see if something's going to play out. And this chart pretty much shows that same thing, but this is adjusted for inflation at the time this chart was created. Then some relative studies. Oil is still doing the best, but it's been coming down, followed by gold, and then stocks, and then the dollar, where bonds based on price are negative. When we do a ratio between the NASDAQ 100 and the S&P, we're hanging in there, showing a little bit of improvement here and still in a longer-term uptrend. And the S&P 100 continues to outperform the rest of the S&P 500. Growth of value, seeing some improvement. We were getting a little concerned. We were coming down to the red moving average. Now we're starting to bounce back up. That could be more positive for the market. Gold continues to outperform on a shorter term basis, but longer term, the S&P is outperforming. So gold is underperforming, and lately it's been pulling back. And gold is starting to underperform a little bit compared to the dollar, but still has broken out above these trend lines. Bonds continue to underperform stocks here on this weekly chart. Low volatility stocks are continuing to underperform the S&P. Discretionary is just not doing as good as we would like it to. It's still in a longer term uptrend, but we want to see this really go up when compared to staples, and it's just not showing a lot of strength, at least follow through strength. Energy had really been bouncing up when compared to tech. Now it's starting to pull back. And then we look at some long-term cycles. We had the NYSE breadth thrust, and that was triggered in October of 2022, and that's still on the books. What we're waiting to see, the window's now closed for a ZWAG NYSE breadth thrust, but we won't get Friday's data until after Monday's close. Now, we had an update, but I don't know. It doesn't look very likely that we had that strong of an update to kick us above the red line. So this may not be generating a ZWAG NYSE breadth thrust, at least right now. The Sahar is still on a full-on buy signal, and we're still above the long-term trend line going back to the 1987 crash with the S&P 500. This is a further blow up of that same chart, or we're starting to go back up a little above the trend line a little further now. And we're declining here with the new highs, new lows for the NYSE, but we're still above zero. And when we look at the 50-period new highs, new lows for the S&P, also declining, but still above zero. The long-term chart of the NASDAQ 100, we're coming back up to the trend line now. So we're not necessarily falling off a cliff, at least yet. And we look at the NASDAQ 100 to Dow ratio, we're right back up to this red line now. So this chart's holding up for the time being. We're also not quite back up to the blue line here, but not very far from it. When we look at the Qs and compare it with the small caps, we're still, well, we're starting to turn down a little bit here with the cumulative new highs, new lows for the NASDAQ. We were starting to bounce back up. That would be more positive if it kept going up. And we're not really changing with the 3-month yield right now. If this really drops or really shoots up, then we'll really take notice of this. Seasonally, and I have a couple of new charts. There's also some charts from the daily videos that I've now delegated to this weekly video. This is May, according to Dan Bird, in the chart that he comes up with, where we tend to see some weak seasonality for the month of May. But when we compare it to 1982 and what happened after that with 2023 and what happened after that, we're still performing at least as good, if not better, when you compare those two periods of time. And then looking at May, going with an election year from 1950 up till now, we do have a positive track record, but the return is almost anemic at 0.1%. May, it's an okay month when we go back to 1950 and we kind of take all the years together. And then we look on a world basis where May is not one of the better months. April was the best month of the year. May is positive, but not screaming positive. And we're watching this. This is just an average, and this suggests that weakness is normal, where even during good times, we do see some weakness going into the latter part of May. We're just trying to get back up to the average right now, where the first half of May tends to be slightly negative. And then, but Carson also came out with another chart showing that May is up 77.8% of the time with 2.3% gains if you measure by the presidential cycle from 1950 up till now. So their returns are a lot different than what we're seeing elsewhere. And they also came out with a chart showing that May to October, that 6-month period tends to be the weakest of all these different 6-month periods. And then we look at the last 10 years where we do see things a lot more positive, where the average gain is 0.7%, with the median gain being 1.1%. And over the last 10 years, we've been up 90% of the time. And then looking out into June, July, and August, a little further down the road, this is when we quite often will see tech really kicking into gear and performing better. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.